Yet another billionaire, hedge fund manager, legendary investor comes out and says something that ends up moving the markets. Today, David Tepper was being interviewed on CNBC, and he said that the stock market now looks like it's the second most overvalued stock market in his lifetime, second only to 2002. So what we are going to do today is to break down why he says the stock market is overvalued. And yes, there's a general consensus that stocks are expensive right now just because they fell a little bit from the coronavirus and then they've come back up significantly from the bottom, and they're currently only about 13% down from their all-time highs. So people just naturally are thinking the economy's bad, but stocks aren't down that much, they must be expensive. So we are going to break down the actual valuation metrics, do a little bit of a primer on how to value stocks and why stocks actually look expensive from an objective point of view right now, and what to do about it. Let's dive in. David Tepper is one of the most successful hedge fund managers of all time. And so for the most part, when he calls something out and he says something, people listen. Now on CNBC, David Tepper said that this was one of the most expensive stock markets he's ever seen in his life. So let's break that down, what it means for a stock market or stocks to be expensive. Take yourself back to your childhood. You run a lemonade stand. Now, this is a top of the line lemonade stand. You've got pink lemonade, you've got limeade, you've got regular lemonade, you've got sugar-free, and you're in prime location. And so you've got customers constantly walking by purchasing lemonade from you. In fact, it's so successful that you are knocking it out of the park, and your one-man lemonade stand is profiting $100,000 per year. Now, you are the only owner of this lemonade stand, so in terms of how many shares exist, it's one. You're the only owner and you own the entire thing. Now, let's say you're tired of the rat race. You've built a successful lemonade stand as a 9-year-old kid and you want to retire. How much do you think you'd be able to sell your lemonade stand for? You're pulling in $100,000 profit per year. How much can you sell this business to somebody else for? Well, that's a great question, because the sale of the business is what determines the value, because before there is actually a sale made, before you're able to transfer that ownership to somebody else, the value of the company is whatever you say it is. Until there's actually a sale, there's no way to verify, hey, this is what the value of the business is, the price of the business is selling at, and then once you have a price, then you can say whether it was expensive or not. Let's say you think, I might try and sell my business for $100,000. Well, if you go and consult anybody about this, the first thing they're going to say is, well, that's pretty cheap, because if you just work in the business and run it for 1 year longer, you're going to make that $100,000 yourself anyway. And so you're going to try and sell the business for more than you could just make by owning it for an extra year. And you say, okay, perfect. Thank you, consultant. That's really good advice. So instead of just 1 year's worth of earnings, how much more should I be selling it for? And for that, we have to take a look at other businesses, other small businesses, to determine how much they usually sell for in excess of their yearly profits. Now, for businesses that generate under $100,000 in profits every year, they usually only sell in between 1 or 2 times their annual profits. And so if this business was making less than that, you would only be able to sell it for the amount that you make in a year. Small businesses are just risky, and since they don't make a lot, there's not a lot of a market for people to purchase that small of businesses. But the larger that company gets, the more you could sell it for beyond its annual earnings. And if the business is making $200,000 or $300,000 a year, then you might be able to sell that business for 2 or 3 times the profit that it makes in a year. So you're sitting back and you're saying, hey, I run a great business. It makes $100,000 per year. I'm going to try and get the top dollar for this company. I'm going to sell it for $300,000. That's 3 times my annual profits. And I can take that nice chunk of change and I can take a gap year, take a mini retirement, and figure out what I want to do with the rest of my life. Now take this concept and apply it to publicly traded stocks. Publicly traded stocks do the exact same thing. It's owners of a company that are selling their portion of ownership in that company to a new buyer. And all throughout the day, sales and purchases are being made of these shares of ownership of these companies, and that pushes the price of the company up or down, and it determines the market consensus on where the price of the actual company is the value of the company. The difference between a publicly traded company and your lemonade stand, though, is that publicly traded companies usually trade anywhere from 5 to 20 times their annual profits. This goes back 100 years. You can see a very well-defined range. Usually the low end, the cheapest, that the S&P 500 on average, the stocks that make up the S&P 500 on average, their price to earnings ratio all put together, the lowest it'll ever hit is really somewhere around 5, and then usually anytime that PE ratio hits 20, stocks start to sell off. So that means on average for the last 100 years, investors are willing to pay up to about 20 times annual profits for a large publicly traded company. Stated another way, if I buy a company with a PE ratio of 20 and the profits don't change, it will take me 20 years for this company to earn what I spent on it in profits. This is the way that companies are valued, and it's the most basic metric of valuation of a company to determine whether it's expensive or cheap. How many years will it take for that company at the current level of profits to earn back the total price that this company is selling at per share? Right now, the S&P 500 is trading at about a ratio of about 23, the price to earnings ratio of about 23. Now, that's pretty high compared to historical standards. There have been times when it has popped above that, and then it corrects itself either through an increase in earnings or through a decrease in price or both, but 23 is pretty high. And again, for the S&P 500, this is just going to be an average of the companies. The companies inside of it are going to vary a lot. For instance, a company like Amazon right now, its price to earnings ratio is 113. So you'd have to own this company, Amazon, for 113 years before the profits that it makes every year, if the profits stay consistent, will equal the amount that you're spending per share. Whereas a company like Delta Airlines right now, it's trading at a price to earnings ratio of about 4, which means it'll only take 4 years at the current level of profits to make back what the price per share is. Now, typically companies that are growing really fast will have really high price to earnings ratios because investors are willing to pay a premium because they can see, hey, this company is growing, so it'll catch up. Yes, it's expensive, but it's going fast. Whereas companies that are priced with a really low price to earnings ratio might actually mean there's something wrong with it. Investors are selling and getting out of it because the future prospects for this company don't look good. And now we get to the crux of it, which is future prospects, forward-looking valuation metrics, namely the forward PE. Now, the forward PE is just like the PE, it's just like the price to earnings ratio, except instead of using current earnings, they're using expected future earnings. Back to the lemonade stand. 2 years ago, you made $25,000 in profits. Last year, you made $50,000 in profits. This year, you made $100,000 in profits. Every year, you've doubled your profits on your lemonade stand. So if you go to sell your lemonade stand for $200,000, that's cheap. Your forward price to earnings ratio would suggest that you're selling that then for a multiple of only 1 of your next year's earnings. And so your forward PE is going to take into account expectations about the future of where your profits will be in the coming year. Right now, the forward PE for the S&P 500 is extremely high, even taking into account the sell-off because of the future expectations of earnings. As the supply chain disruptions ripple throughout the economy and unexpected economic forces are making their way across financial markets, future earnings expectations are pretty low compared to historical norms. Yet the prices of the actual stocks themselves have not adjusted to that lower expectation of earnings. Their prices have maintained a relatively high level. And so the forward PE for the overall stock market, the price per share compared to the expectation of future earnings, is at a level that caused David Tepper to say this is the second most expensive stock market that I've seen in my career. Now, this, along with Powell's remarks about the fact that we're not going to have negative interest rates, I called that in my last video, caused the stock market to sell off today. And if you look at this intraday chart of the S&P 500, you can see there was a steep sell-off, and then it bottomed out at about 2,800. Came back up, settled up a little bit above that. And if you look at this longer chart, last couple of months about the S&P 500, you can see here that that 2,800 level is a pretty good support and resistance line, and we held above it today. Now, understanding that since negative interest rates nominally are not being introduced, at least not yet, more QE and more debt monetization will have to happen to deal with the ramifications of the economic crisis that we're facing, which pushed gold higher. Now, you can see gold is still in this consolidation pattern here. It's still in this symmetric triangle that we see here. It did settle out at the top of the range today, but I would expect that once we do break out of here, we will see a rally retest those highs for gold. Now, seeing the stock market sell off today like it did, I would fully expect that over the next couple of days, couple of weeks, we will see a more aggressive response. Maybe Congress will make more progress on the next measures to send out helicopter money for everybody who is unemployed. Maybe an infrastructure plan will be laid out. Whatever it is, there's going to be a lot more spending coming down the pike. And this will have the effect that it's had since the markets bottomed a couple of weeks ago. It will drive stocks higher. Like I said in my video over the weekend about bad economic data, it actually helps drive the overall stock market higher, because as bad economic data hits, more spending happens, and due to the Cantillon effect, the spending first hits asset prices. So yes, stocks are expensive, and I think they will continue to look expensive for a very long time. I don't think we'll see deals in the stock market anytime soon, but I do expect stocks to continue to go up from here. We'll see how things unfold, and I'll keep you updated on whether that opinion changes or not. If you do have any questions or thoughts, let me know in the comments section below. If you enjoyed the video, hit that like and subscribe button, and I really appreciate you guys. Have a great day.